Australia's economy has slipped into a per capita recession, registering 2 negative quarters of per capita GDP growth. According to the Australian Bureau of Statistics, on a seasonally adjusted basis, GDP jumped 0.4% in the June quarter and was up 2.1% for the year. Productivity growth, or GDP per hours worked, fell 2% in the June quarter, and that's a major concern for the Treasurer, Jim Chalmers.
So productivity is a challenge in our economy. It was a challenge in our economy before these national accounts made it clear. And as we have said for some time, this productivity challenge has taken some time to build, and it will take some time to turn around. It is partly global. It is partly a consequence of a wasted decade of missed opportunities, which meant that productivity growth in the 10 years to 2020 was the slowest decade in the last 60 years. So we've got a productivity challenge, and what I've tried to do is to broaden out the productivity frontier beyond the usual suspects to include things like the energy transformation, adapting and adopting technology, and getting the human capital piece right.
Joining me now is Bess Adetta, Chief Economist at St George Bank. Bess, thanks for your time. Let's start with the Treasurer there talking about productivity growth. How big of a challenge or a concern is this for Australia?
Look, it is a big concern. We are seeing productivity head south, and it is a very big challenge ahead of us. And what's more is that weakness in productivity has contributed to a rise in unit labour costs, which is wages adjusted for productivity. And that then means that there could possibly be more challenges ahead for the Reserve Bank in trying to bring down inflation. Inflation peaked last quarter. It's heading down. It's in the right direction, but it's still well above the target band of 2 to 3%. And this weak productivity backdrop and unit labour costs rising suggests that it could be a sticky ride back towards the target band.
Looking at the overall numbers, GDP growth in the quarter up 0.4%. That was as anticipated. Are there signs, though, that our economy is slowing down a bit?
There's certainly signs that the economy is slowing. But what I would say is after 12 rate hikes since May of last year, these outcomes for GDP are reasonably good. If we think about it, the year-on-year rate of 2.1%, well, that's just a tad below trend, and it's higher than what the RBA forecast of 1.6% at this point in the cycle. There is evidence of slowing, and that's really coming from the household sector. Household consumption really only grew a tad, and that was due to the explosion of the population growth story. In fact, if we remove population, we can see that economic activity led by consumers is slowing more sharply. In GDP per capita terms, for instance, that went back 2 quarters in a row, and that means it's a recession in per capita terms.
Yeah, just explain what that per capita terms actually means.
Well, what that's trying to measure is economic activity per person. So it's trying to strip out the impact of people. If we think about population growth, it grew by 2.4% in the year to the June quarter. That's very solid. Now, we expect population growth will remain very strong, but probably not at that very solid pace going forward. Certainly, the more people that come to Australia, the more spending that takes place. So that provides a layer of resilience to economic activity, and that helps the real GDP figures be better than otherwise would be the case. But when we look at it in per capita terms, it's stripping away that impact of population.
Mm-hmm. And consumer spending, you did say that is slowing down household consumption. And what about the household savings ratio? Are Aussies dipping into their savings as well?
They are dipping into their savings. That household savings ratio did come off from 3.4 to 3.2%. As I said, household consumption growth has slowed, and that's because budgets are being squeezed from higher mortgage rates, inflation, and also the sharp rate of growth in rents for some households. So we expect that slowing to continue over coming quarters. And, you know, what we also saw in the data, Ed, is that there was a shift away from discretionary spending towards essential goods spending. And that's also a sign that budgets are coming under pressure for households.
Tuesday this week, RBA kept the cash rate on hold. Were there any surprises there for you?
Look, there wasn't a lot of surprises with that decision. We were expecting the decision to stay on hold, mostly because the data that had come out since the last RBA board meeting, didn't really suggest that they needed to hike again. So we were expecting that pause to come through. When we look through that statement, there were three things that jumped out. The first one was that there was a bit more confidence around the peak in inflation being late last year and inflation coming down. The second one was how they characterised the labour market. So moving the language from very tight labour market to a tight labour market. That's a tweak, but possibly a sign that we are at a turning point in the labour market, with job vacancies starting to come down and the unemployment rate starting to tick a little bit higher, although from a very low level. And the third piece, Ed, was that they inserted a sentence around China and the fact that there was uncertainty about the global economic outlook, particularly related back to China and their property sector.
And tomorrow we're going to hear from Governor Philip Lowe. He's speaking at the Annika Foundation. Do you think he's going to reflect at all on his career?
Well, certainly I'm hosting that event because it's been done jointly with the Australian Business Economists, and there will be a celebration of his career. No doubt there are, various speakers on the day, but of course the keynote address is by Philip Lowe. Look, I imagine there will be some touch points on monetary policy, particularly given that he has kindly agreed to take questions from the audience.
Best Adetta, thanks so much for your time.
Thank you, Ed.